Good morning, everybody. This is live daily market outlook from Windsor Brokers for Wednesday, 13th of February 2013. The main highlight for pardon, the beginning of today comes from yesterday's G7, the G7 comments that fired warning shots over the currencies and further confusing the markets. The group of seven rich nations sought on yesterday's meeting to cool growing tension over exchange rates, basically sparked by weakness in the Japanese yen. But from the other side, currency markets found the effort lacking in clarity and triggering a second straight day of quite high volatility. The G7 group declared that fiscal and monetary policies would not be directed at devaluing currencies. A statement meant to soothe nerves that Tokyo was aiming to guide the yen lower with its aggressive expansion of monetary policy, and basically this has put more oil into already overheated tensions between the G7 members about currency war. Japan from the other side said the statement gave it a green light to continue efforts to reflate its economy, but comments from G7 said it was aimed squarely at Tokyo, prompting the yen to surge. And of course, as a result, rather than calm the market, the purely communicated the statement that was basically bringing the main confusion has significantly raised the volatility. As a top performer yesterday, dollar yen again dipped, strengthening the Japanese currency as low as 92.80 of recent peaks posted yesterday, the day before at 94.40 and then 94.45. From technical point of view, bulls are still in play while we are above 92, but near-term structure has been slightly weakened after this dip and the sharp move lower, and that especially that cracked the initial 93 support. From the other side, the euro holds stable, still unable to clearly break above 134.65. That is seen as a break point, and also the near-term channel resistance, also midpoint of the recent decline, but near-term structure is still aligned towards the upside and still sees more focus for some stronger recovery. Cable regained all yesterday's losses, sharp fall lower and a quick recovery back basically slightly above the yesterday's opening levels, but still lacking strength and momentum for now. This is what we are talking about, beginning end of Asian and beginning of European session, still evident lack of momentum, and the strength is still evident on the near-term structure. We need to see the regain of 157 in order to improve the near-term structure. With dollar yen, we mentioned already, dollar Swiss is in the range, but near-term focus is still towards the downside base of the recent range, interrupted by a brief break above 92 that was short-lived at 91.50. Gold remains weak after posting a fresh low at 1639 yesterday. Brief recovery higher, did not see much of the action as 1650 zone, previous low, so far capped the upside, and gold remains weak in the near term, with the investors still not seeing it as safe haven instrument for now, due to the higher risk appetite mode that has been introduced in the markets. I do apologize, there is a problem. I'm not muted. If there is a technical problem, just a minute. As I said, we have a small technical problem. One of our attendees cannot hear the audio. Okay, back to the markets said gold remains under heavy pressure. Most of investors are still coming out of it, and especially the lower demand on the thinner markets now due to the Lunar New Year in the China and the Far East sees a lower demand, and of course the thinner market makes more significant movements in case of any trading, which is in this point more bearish. So main focus still remains at the downside. We have 1635 and 1625 as our initial focus, while crude oil holds steady after breaking above initial barrier and the congestion top at 77 seen so far. Again, focus shifts higher following congestion that lasted from the beginning of February. That was contained by 95.00. Now again the focus is seen towards the upside. And a quick look before we move to the technicals, a quick look on the today's calendar. German data WPI for January released at 7 o'clock. GMT shows wholesale price index shows 0.3% increase in January compared to flat the release in December, and the 0.4 forecast. Swiss PPI I think is already out. We don't have it again. We'll find out in a second. Meantime, we can talk about the other Swiss PPI. Just a minute. Monthly release came at 0.1% versus 0.2%, so unchanged from the previous release at on December at 0.1 and below the forecast of 0.2%. Industrial production from Eurozone for December monthly release is due at 10 o'clock. GMT 0.3 improvement, 0.3% forecast versus the minus 0.3% of the month of December. And then 10:30 we have the inflation report from Bank of England, as well as speech from the Bank of England Governor Mervyn King that will give us some more clue about further steps of the Bank of England in the near term in order to handle the current situation. And I do apologize. Retail sales, this is basically one of the key releases for today, along with the UK data. Retail sales for January in the US are, according to the forecast, expected to drop by 0.1% is the forecast compared to 0.5% in December, while also the decline in the core retail sales 0.1 compared to 0.3%. This is going to be interesting, and we should pay more attention on today's release of US retail sales. This is one of the important indicators of the situation in the US economy that is again showing signals of weakness and limping after the initial positive signals given from the previous releases, with of course labor market being the most painful point for US economy for now. That was basically all for today's calendar. We have the US crude oil inventories weekly release at 15:30 GMT. Build of 2.4 million barrels during the past week is seen on today's forecast compared to the previous week. A build of 2.6 million barrels. No significant changes according to the forecasts. And we're going to take a look now at markets to see the latest movements and technicals for major currencies and commodities. As shown on the hourly chart, the euro has gained some ground of 133.52 base, retracing approximately 50% on yesterday's rally to 134.74. But until this was all seen yesterday, and then most of the overnight session was spent in the consolidation that was being contained by 134. 30 approximately, that is still above the previous range tops and the peaks at 134, 28, 26, contained also by 4-hour 20 days exponential moving average that still keeps the still keeps the near-term focus at the upside. Repeated attempt through the channel and bear trend line resistance is seen at the beginning of European session. We need to see the break above 134, 65, 72, 74. That was the recent high in order, a sustained break in order to confirm, as hourly structure is still in the positive, hourly studies are still in the positive territory, and still see upside slightly favored, while 4-hour indicators are gaining momentum, but still below the midlines. That requires, of course, a break above, a clear break above 94.65, with regain of 95.00 seen as the next level. This is above 61.8%, required to confirm the recovery and signal some stronger corrective action, with initial signal being given on the break of the channel resistance that is currently at 134.60 approximately. Holding above 134.30 keeps the immediate bulls in play, but any slide lower, and especially loss of 134.00, would risk again a return towards the lower targets at 133.50, which is the recent base. Daily structure is still, studies are still in descending mode, and the improvement again requires a break above 135.00 that would signal some stronger corrective action, and introduce levels at 135.76 and 136.00, required to shift focus towards 137, 137.10. Failure to hold, to clear these previously mentioned levels, 134.65 and the more significant 135, would still see increased downside risk. But of course, today's close and the break and close above 134.65 is seen as a supportive element at this point, as single currency remains still in the uptrend, and the latest movement is could be described as corrective, as long as we are holding above a more significant 133 and the 132.65 higher platform in the previous peaks. Also, the later one is also the main bull trend line drawn of 126.60 low of 13th of November 2012, and the British pound against the US dollar, as we said, it regained all yesterday's losses. Bounce of fresh 2013 yearly low at 155.75 by 71, came back to the slightly above the opening, yesterday's opening levels, and that was all seen so far of recovery, slightly above 38.2% of the latest down leg from 158.43 to 155.71. Basically, we mentioned in yesterday's also comments that regain of minimum 157, that marks midpoint 50% of the entire down move, would bring some more positive tone into the near-term picture, as we can see that hourly indicators are again losing traction. Loss of momentum basically sees, lack of momentum sees the inability to regain 157.00, but still slightly positive tone that persists on the hourly chart, sees potential for a possible attempt higher, though the price recent price slide below all three moving averages on the hourly chart sees increased downside risk, as we dipped as low as 156.36. Basically, break below 156 zone would be seen as increased risk towards the downside. Any move above 157 is to required to delay immediate bulls, as bears, as the overall picture is very bearish. And as I mentioned in yesterday's comments, loss of near-term range floor and the more significant trend line support. This is a longer-term trend line support from trend line of 2009 low. sees more risk towards the downside. Two strong bearish signals were given, with any bounce higher to be seen as corrective. This correction would increase in case of a regain of 157.00. Otherwise, increased risk down towards 156.00, 155.71, and then extension down towards our next targets, 155.30, 76.4% retracement of the larger 152.67 to 163.80, and the 155.00 as a round figure, and the psychological support. Basically, these levels are seen as our next upside downside targets, with any stronger, more significant improvement seen requiring a regain of 158.43. This is last Friday's peak, and the 158.77 peak of 1st of February. Also 200 days moving average only break above these levels. If we round it, then the break above 159 would provide the near-term relief and prevent the pair from further extension lower. Otherwise, we are still in the strong downtrend, with the near-term bounce higher seen just as corrective. While the dollar yen, as we mentioned at the beginning, weakened its near-term structure. Yesterday's sharp slide, basically triggered by comments, confusing comments from a G7 group, retraced between 61 and 76.4% of initial rally from 92.17 to 94.45. Important was a loss of 93 handle. That also marks a 61.8% retracement. Initially, it was just cracked down to 92.93, but fresh weakness after leaving a lower top at 93.61, dipped as low as 92.81, and now we have a more weakened structure, near-term structure, more weakened at this point, with the 20 days exponential moving average so far capping at approximately 93.30, while strong barrier lies at 93.61. This is yesterday's intraday high and the lower top of the recent descent, and any failure to break above this level, we're still in a sort of positive tone after a bounce higher regained 93.00, while holding above 93 still keeps possibilities of fresh stretch higher, but initial requirements is seen on the break above 93.60 in order to shift focus toward the upside barriers. Basically, we need to see the break above 94 in order to confirm the higher low at 92.81, and then shift focus again towards upside targets at 94.40 and 94.45. Conversely, any slide, any reversal below 92.61 would see the continuation of lower tops and lower bottoms. That defines basically the downtrend from yesterday's peak at 94.40, and the risks, of course, the double top formation that will be confirmed on the loss of our key support at 92 zone. This is the near-term base 92.00 and 92.17, also marking a 38.2% Fibonacci retracement of a rally from 88.05 to 94.45. Initial trigger is seen on a break below overnight sell low at 92.81. That is also 4-hour 55 days exponential moving average. So far, the hourly structure is still negative and still sees downside at risk as long as we are below 93.61. break of this level would signal some improvement in the current structure and avert immediate downside risk. This is also the midpoint and 50% of the entire down leg from 94.40 to 92.81, and seen as a break point and trigger for some stronger recovery. Otherwise, the downside would remain at risk, as we said, in case of reversal under 93.60. That would risk a retest of 93, 92.81, and possible slide down towards 92.00. Break below 92 is required to confirm the temporary top at 94.45 and allow for some stronger corrective action of a very strong rally of dollar yen that persists from September 2012, when the pair rallied from levels approximately 77 to 94.45 so far, seeing the highest level. And the dollar Swiss, as we can see on the ADX studies, there is no direction, there is no strength. We are in the sideways movements, but the tone is still more bearish rather than bullish, as yesterday's brief break above 92.00. This was the initial requirement to resume recovery. That marks 50% retracement of 93.87 to 90.20 descent, seen as a trigger for a stronger recovery. So far, this did not occur, as the pair failed to break here to sustain gains. 92.13 seen so far, with the gains being again limited by daily Ichimoku cloud base, and the fresh slide lower, still holding this sort of positive momentum from 90.20 with the 91.50 recent range floor containing the dips. And still we are in the sideways movement at this point. Slightly, the near-term structure is slightly aligned towards the downside, as shown on the hourly chart, while 4-hour indicators are now sliding following yesterday's rejection, and the risk is seen on the break below 91.50. That is reinforced by 55 days exponential moving average to further retrace the recovery rally from 90.20 to 92.13, with immediate risk seen down towards 91.00, that loss of which would reintroduce a recent low at 90.20. 91.34 is interim 50% retracement, and then we have 61.8% at 91.15. We are talking about rally from 90.54 to, I do apologize, let's make it whole, from 90.20 to 92.13, and now we have fresh levels. 91.40 is the 38.2%. Basically, the strong support lies at 91.40.50, and loss of these levels would be a signal for some stronger reversal that will sideline immediate near-term bulls recovery from 90.20. While conversely, break above 92, clear break above 92 requires clearance of 92.47, 61.8% retracement in order to shift focus higher and avert immediate downside risk. But underlying an overall bearish trend still persists, and any bounce higher so far is seen corrective, as long as we are holding below these two tops, 93.87 and 93.81. Basically, a regain of 94.00 would improve the overall picture. Otherwise, fresh lower tops and the slide lower are seen as the near-term scenario for the dollar Swiss. And quick look at commodities. Gold, no significant changes from yesterday. Bounced higher. Yesterday we have seen, this was after our update, when the yellow metal hit fresh low at 16.39. It tested the last support 16.42. That was low of 7th of January 2012, opening way towards 16.35, and 16.25 key support low of 4th of January 2012, with some brief corrective action seen of 16.39, retracing between 23 and 38.2% of the entire rally from entire slide, from 16.83 down to 16.39, being capped by descending hourly 55 days exponential moving average, and the fresh slide below 10 and 20 days one, with the bearish crossover of 10-20 moving averages, putting additional pressure to the yellow metals price, building up bearish momentum, and again increased risk is seen towards the downside. The supports at 16, initial one is 16.43, then 16.39, and then of course we have our key level 16.35 and 16.25. 4-hour structure is negative, with the current bounce being short-lived and basically capped by previous low at 16.51, with the descending 4-hour 20 days exponential moving average maintaining immediate bears and keeping the downside pressure. In any case of any stronger corrective action, we need to see regain of levels. I would say 1666, that marks 61.8% retracement, and basically this is also the floor of the previous consolidation range. Regain of these levels would improve the near-term structure and avert immediate downside risk, but it's seen quite unlikely at this point, according to the current structure that maintains quite a negative tone on lower and larger time frames. And finally, the crude oil. Improvement is seen on a break above recent congestion tops. That also marks 61.8% Fibonacci retracement at 97 zone. There was congestion in past couple of days between 95 and 97. 95 also marks the previous low of 23rd of January 2013, and was seen as a good support that can contain the two attempts. Lower initial one was on 6th of February, and then the last one at 11th of February, with subsequent quick recovery. Again, fundamentals played quite a big role at this point, recovering the current structure and shifting focus again towards the upper boundaries. 97, 77 so far is focusing again, pardon, 98, 22 recent peak, and then we have 98, 54 Fibonacci expansion of 61.8% of the entire wave from 84.05. Overall, near-term structure has improved now and sees more potential towards the upside, sees room for fresh extension. This is especially significant on the 4-hour chart, with the bullish crossover of 20 over 55 days exponential moving averages underpinning the action, with the break above 98, 22, 54 required to shift focus again towards our previously defined and seen target at $100 per barrel. That's all from my side. Now we already have some questions. Just a second, let me read it. Okay, we have a question about Mario Draghi. If says, well, says high euro is harmful to EU exports. Why do the traders push the EU up to cause further problems? Basically, this is this is what we said at the beginning. There is also this so-called currency war now. Yesterday's comments and the day before comments from some Eurozone officials saying that euro current high levels of euro are not harmful for the single currency. Boosted, this was yesterday's initial rally higher. There are sometimes contradictory comments from EU officials when one says one thing and the next day the other one comes. We faced this, I think, 1 or 2 weeks ago. Again, Draghi was involved, and I'm not sure, one of the top Eurozone officials. Most of the things is, I do agree with you, it's slightly high, too high, the euro for my point of view, but it seems that positive sentiment is still among the number of traders that keeps it higher. I didn't read yesterday's comments, to be honest, comments of Mario Draghi. I'm trying to find something now to see what was the story, but overall sentiment positive, and if investors are pushing and the traders are pushing it higher, then it goes higher. I mean, this is just the fact. The market depends on the demand and the offer, so quite a strong demand for single currency still keeps the a positive tone in play. Now, if it's the other side, how it's going to be, how it's going to affect the overall performance of the Eurozone. I would say the more significant is comments from G7 yesterday that made a bigger confusion into the markets rather than Draghi's comments. If you recall his previous comments 2 weeks ago, and now I remember when he said that Eurozone is in a good path and going towards recovery, and then last week's after central bank rate decision comments that the situation is more gloomy and they still sees quite weak signals for the Eurozone economy, and that the economy will stagnate at least for the first half of 2013, and some signals could be expected in the second half. You can see that he's contradicting himself and basing his comments on present data, maybe that he receives at that time. We had actually some positive releases at the first case when he was very optimistic. I disagree with this because you cannot judge and base think on one positive signal. You have to have a number of positive signals to connect them all into bigger picture and see whether it's really working or not. A similar situation is still seen also in the United States when 2-3 indicators come better than expected, and then whole euphoria comes out that economy is recovering, and of course cold shower comes after the next release. Mainly it comes from the jobs data that brings the things into their real levels. I hope it was understandable what I explained to you. We had the other person. I hope we solved this problem with the audio. You cannot ask me question through the microphone. You have to type and send it, because if I let everyone talk, then we'll have a group of big group of people talking at the same time, and it will not work correctly. So we decided to have it questions sent in written form, and then I answer to everyone, of course. Unless this question was purely technical. Okay. If you need the chart settings like mine, then you send me your email. You can see the email on the screen now, analysis@windsorbrokers.com. Send me your email so I can have your address, and I will send you all the templates for the configuration that I have. So most of the attendees actually asked me already before, so we are all looking at the same picture, and it's quite makes the life much easier at this point. So just send me one email with your address, and I will send it to you during the day. I can see your email, but if you don't mind, just send me an email to analysis@windsorbrokersltd.com, because once I close the program, this message will disappear. So please, if you don't mind, just send me the email to make the life easier. As I see, we have no other questions for today. I would like to thank you all for being with us. To thank also to the newcomers that we have some new people joining us today first time, and expect of course to see you all together again tomorrow in our regular session that starts at the same time at 8 o'clock GMT or at 10 o'clock local Cyprus or South African time. We are in the same time zone. Wish you a nice Wednesday. Good luck in your trading, a lot of profits, and expect again, as I said, to see you tomorrow morning. Good luck.